Good morning, everybody. Nash Paradise, your boy, the Lone Wizard, here with my good friend, Matt Gougé. How are you doing this morning, buddy?
I'm doing good, man. I'm excited for a fun week. We got, the holidays around the corner, so a lot of people are decorating and wrapping and putting up stuff, which is, it's a feel good time of year, I think, for a lot of people. Hopefully, most people out there are having a, good holiday season, a lot of good eating, a lot of good family and whatnot. So yeah, that's where I'm at right now.
You could even say it's the most wonderful time of the year, I think.
You could say that. Yes.
I should write a song about that. But it's not usually a very busy time when it comes to Monday market updates and a lot of things moving in bonds and stocks and treasuries. And yet here we are going to talk about some really cool stuff that's been happening and some fun, exciting things going forward. So if it's cool with you, Matt, let's jump right into our weekly recap. So getting into last week, we talked a little bit about there is some big news coming. We're going to see, decent numbers coming out on Wednesday of last week, the S&P Global Services PMI, the ISM Manufacturing PMI, and Powell is going to speak. We got a lot of no big deal, nothing interesting, nothing cool. All right, cool, no big deal. We had some stars on the calendar for Friday, though. Non-farm payrolls, that was the big interesting one, because if you remember correctly, the previous month, NFP came in at 12,000 jobs added, which was really, really weird. Market didn't really know what to handle that. I don't know if you saw yet, Matt, but it has been revised only from 12K to 36K. So it seems to be a pretty well-supported number. What are your thoughts on the new Friday, December 6th non-farm payrolls, or have you even seen them yet? I don't know what you were doing between Friday and today.
If you asked me, 227 was the number, right?
Yes, sir. 227 off of a 200K projection. So a little bit higher, but definitely more in line with, what we'd be expecting.
Yeah. As stated before, I'm not digging too deep in here, not trying for my master's in economics, but, still watching those numbers and seeing how they affect mortgage interest rates. And for me, and for a lot of people watching, probably, like, they want to know what time it is, more than they want to know how the watch works. And so I think the thing that was surprising to me was it wasn't a crazy day in data where things were that far off from expectations, but rates seemed to get better.
Every day last week for the most part, and it was funny too, when you're looking at the graph, things get better, and then at open they drop, and then they improve throughout the day, and then at open they drop, then improve throughout, and that's just people taking gains, taking wins. But like, it's just kind of funny, watching, especially keeping up with the 10-year treasury bond, finding those resistance points. We've been hitting it's funny, for like 5 days in a row, 10-year yields closed at 4.17%, which is a really good, percentage, just in watching mortgage rates and knowing what's been going on for the last month and a half. 4.17 sounds great, especially when we were, toying with the mid fours for a while. But just very funny that we kept closing at that. And yet the UMBS securities kept improving. Rates kept getting better a little bit Monday, Tuesday, Wednesday. And then by the time we hit Friday, we're at a 30-day high on interest rates. 30-day high as far as UMBS securities pricing, which means a 30-day improvement. the best rates that we've seen in the last month happened on Friday. What's your take on that and why things were getting significantly better for not a lot of really any good reason?
You know, I don't want to speculate, but I think that
That's what we're here for, Matt. We're literally here to speculate.
Okay. Well, if I'm gonna guess, as a mortgage guy, whose main focus is to take whatever I've got and structure the best mortgage with it. But if you ask me, I think there's probably more certainty, stability in the mortgage-backed security market. And without getting too nerdy, we've always talked about this wide spread between the 10-year and 30-year fixed. With more certainty, with less volatility, that spread is going to revert back to the 1.8%, 2% historical norms, not the almost 3% we've been seeing it at lately. And so that would be my guess, more than any data or any, news from the Fed. It's just that there's a little bit less volatility, and less volatility equals lower mortgage rates.
Yeah, that's got to have a factor. You can also look at, international indexes and international bond markets, with everything, the unease and things going on in Syria. Anytime there's, things happening in other parts of the world that are complicated, confusing, when there's, war and, things that could really disrupt supply chains or even just like the global economic spectrum, you're usually going to see money go into 10-year treasuries, and that's going to drop the yields and therefore improve mortgage rates a little bit. So could be a number of factors. I'm with you. It seems like unsupported improvement is likely due to the hedging and the margin spreads being reduced slightly. But let's take a look at the charts here and see where things are trending. I like this one. We've been talking about this chart a lot. This is the three largest aggregators of mortgage interest rates. You've got Mortgage News Daily, Freddie Mac, and the MBA. The most accurate of which for me is always going to be that blue line, the Mortgage News Daily. They update every single day, and that's why there's a lot more movement there. But talk to me a little bit about what you've been seeing just in these last 5 to 7 trading sessions.
Yeah, I mean, improvement is always good, and I've said it here before, and it holds true. I have this conversation at least once a week. Trajectory of mortgage rates matters almost as much as the actual rate itself. So if you look at the dip, on the chart, mid-September, about 6%, if you follow that line up and you get to whatever date, it's probably in November, we kind of went up to 6.75. I would bet you, talking to a consumer on that day during that time, buyer sentiment is worse than today, where we're also at 6.75. So the rate is exactly the same, but the prior weeks saw 7.1, 7.15. And so we're headed down from a mortgage rate trajectory standpoint. People like that. And, it's going to be interesting. It's always funny to couple the dynamic of lower rates equals more demand. If you want to debate that, anybody feel free to, comment or whatever, but it's the truth, right? I was listening to Logan Matashami from Housing Wire this morning, and mortgage rates go down, demand goes up. That's just, it's a fact. And so it's going to be interesting to see that dynamic along with February, March, April. Those are busier home buying months. There's more demand during those months than there are October, November, December, as people are kind of winding down for the year and there's not as much real estate being transacted. So I'm interested to see what happens in 2025 with those two things, which are some of the biggest drivers of, how much real estate is going to be transacted. The seasonality portion of what time of year it is, along with where are rates and how much demand does that either A, unlock, or B, keep on the sidelines. Higher, more people stay on the sidelines. Lower, more of those people start to come back into the home buying market, and then that has its effect on inventory and prices and everything else.
And I think you hit on something truly genius, and I'm sure it was by accident, but you're 100% right. And I think it's worth restating. It's less about the number than it is about the momentum. Momentum is everything. So like you said, as we hit this increase in interest rates, where from middle of October to October 23rd, that's when we shot up and saw that 6.75 ish range that you see there on that chart, the very fast improvement. Sentiment between loan officers, real estate agents. I mean, we're the ones to blame. We're the ones who are sitting there like, oh man, I had a 6.25 and now it's a 6.75. The sky is falling. Things are going up so fast. Hey, don't worry, client. Maybe it'll get better. Let's just hold off. Let's pump the brakes here. Versus right now, where we've come back down to a 6.68. Now it's, hey, it's a great time to lock. Everything's wonderful. Look at what we've done. Look at where we've been. We've got such short memories. We focus on what's happened the last week to 2 weeks, and we set these expectations on this is your payment, this is the interest rate we're looking at, knowing full well that it takes a while before getting under contract, before finding that right property. I mean, we are the cause of and the blame of a lot of that consumer sentiment. Consumers don't necessarily know when they went from 6.25 to 6.75 without us saying something. And the way that we present that, the way that we feel about that is going to come through a lot. And, to the opposite end of the spectrum, going from the low 7s here a couple of weeks ago into the mid 6s now, it does feel like a big win. So I'm sure a lot of loan officers are going to be out there pitching this big win, getting people excited because the momentum is in our favor. Whether they keep going down, stay flat, or, go up a little bit right now, momentum is at a high. And, loan officers are going to be excited to go out there and sell it.
Yeah. And there's a lot of truth to, telling the consumer, hey, listen, with 6.6, you've got more buying power than you had weeks ago at 7.1. It takes time for this stuff to kind of move through the market as far as people actually taking action. So the more in front of it you are, the better. As a consumer, I would be really excited about it's December. Anybody who's on the market between Thanksgiving and Christmas has to sell. They're not strategically timing, a December 9th come to market listing. It's divorce, somebody in the family passed away. It's selling for a reason, which means you can get a deal because they're highly motivated to get this thing sold. And so couple that with, hey, I've got an extra $50,000 in buying power, or I can buy the same house for, $200 less per month because of the interest rate that's tied to the loan I'm getting. It might just be, for some people, again, real estate is something that is like so many unique scenarios. So there's no one size fits all, something that works. But I'd be looking out for some great opportunities, both in, real estate deals to be had because of the time of the year, and then recent pop down in rates that not everybody who's on the sidelines got that memo yet.
100%. There are winners in every market. There are winners with every bit of movement. The first people to act as rates are going down, like you said, they're going to have an advantage. It's going to take a while for the market to catch up, for buyers to come out of the woodwork, especially now during this December timeframe. There's not going to be enough listings hitting the market for all the same reasons you said. It's a great reason to find those right buyers who really need to do something right now and need that extra affordability, who need a lower down payment, maybe can't compete in some of the spring market. There's going to be some wins out there. Let's jump straight to the dot plots and see what the Fed chiefs are saying. And oh man, is this not a big difference from what we talked about last week? What are you seeing here, Gucci?
Yeah, I mean, a lot of data last week, and with data comes, updated projections. The Fed actually spoke last week, and so, they glean from that what it means. And of course, we're getting closer to this Fed meeting, not this week, but next, right?
Yeah, December 18th.
December 18th. And so, it's almost certain we get a 25 basis point rate cut. And I know we talked about it last week. I'll let you, give your thoughts on, we're likely to have a cut either now or in January, but not as likely to get both. I'll be interested to see what the January projections say about possibly getting one in December and January. But
yeah. I'm with you. Let's go ahead and fast forward to the January and take a look at that and see, and thankfully it has improved a little bit on 2 cuts, but the vast majority here is still looking at 1 cut between December and January. In the last couple of weeks that we got together, my analysis and assessment was January was probably going to make the more sense to give us a lot of data in the interim. This week is going to be fairly critical, and we'll talk about that after we go through these charts and see what's going on now, because again, we're very data driven, but based on all the different Fed speeches last week, it does seem highly likely at this point that we're going to be celebrating a Christmas with an extra quarter point off. But, like you said, through now and the 29th meeting, those two meetings, vast majority, 70% now are just stating the one cut between those two. Let's take a look and see what the March meeting looks like. And unsurprisingly, by the March meeting, we're projecting a second cut. I don't think that's a surprise for anyone here, but because of how spread out this is, I think what it's really saying is we don't know, and trying to project too far out into 2025 is kind of silly at this point. And that's what I'm taking. What do you think?
Yeah, and listen to smart people like that podcast I listened to from Logan Matashami. We can see enough into the future to say it's really certain that we get a cut in December, and beyond that, it's wait and see. And like you listen to any Fed president speak, that's kind of what they're going to say. Logan was talking about, it might be that they're going to slow roll and kind of slow play this enough that we shouldn't expect many back-to-back rate cuts. It might be like cut in December, take a pause in January, reevaluate to see if we want to do it on the next meeting. But, there's no data and there's no real reason to do any, multiple rate cuts 3 months in a row, any type of like 50 basis point versus 25. There's no data currently. That can always change, right? That would, justify any, big moves by the Fed.
Well, and I think that's what we saw earlier this year is a little bit of over aggressive movement that didn't really adjust the market in the way that we thought it would. We had a few different months where the charting was inconsistent, and what that led to was some really inconsistent interest rates throughout the year. There was not a lot of stability there, and I know what Powell would love to do is get to a more stable market going forward. So let's move on from the slides into this week at a glance. We've got huge stuff that could change everything this week. It's a big week as far as numbers go. I am looking straight on at Wednesday, December 11th. We have got month over month core CPI for November and the year-over-year core CPI. So those are projected to stay completely flat, 0.3% on the month over month, and the year-over-year at 3.3%. No news is going to be good news on those, but there's always an opportunity that something comes in a little bit different than what expectations are, could really throw things for a loop. What do you think, Gucci?
Yeah, like you said, it's worth repeating if people didn't hear it. Where the numbers land versus the expectation is where you'll see market movement. If we expect a certain number and we get that number, then any type of rate adjustments or whatnot are already baked in because we already knew that. But if we project 3.3 and we come in at 3.5, then there's like, oh my gosh, inflation might not be as in control as we thought. We might have to pull some levers, more likely for more rate cuts, and then it affects more mortgage-backed securities, ultimately mortgage rates, and so it'll be interesting to see. I don't think there's these end of year CPI numbers. Like last time I looked, I think I recall there's not a lot of room for us to have massive improvement because of how low those numbers were last November and December. And so there's more risk in there than there is, any type of thought of, it's going to come in a lot better than expected. So it'll be interesting to see.
Yeah, no, you're 100% right. I mean, there is on Thursday, the core producer prices year over year is anticipated to increase a little bit from a previous of 3.1 to a 3.3, which is slightly different than the year over year core CPI. But all that to say, November to November, because the numbers are so much lighter, we should not see any massive movement. If we do, that's gonna set off some alarms. But I feel like we are going to be fairly consistent. If we come in at 3.2 or 3.4, that's fine. That's not going to move things too much. But, looking at where the Fed would like to get inflation down to the low twos, we'd really like to see some of this consistency happening out there. So where, it's going, if we come in right on the mark, it's really going to support a December 18th quarter point cut. If we miss a little bit, it could push it back to January. We could be having an interesting discussion next week. But as this relates to mortgage lending and any professionals that are paying attention to this, it's like it if you lock it if you like it if you lock it. I hope you like it if you locked it, but it's just going in and taking your wins. We've had a lot of improvements. Yeah, things are going down and we're on that trajectory, but you can't look at the past as any kind of metric or measure for the future when it comes to mortgage rates. Just because we've had 5 great days in a row, it doesn't mean we are moving towards this trajectory. We are still very much data driven, and any day could turn that slightly or it could turn that severely. So, my analysis, my looking forward right now is it's a great time to lock. If you're one of those people taking advantage of a December market, you're going to be very, very happy with where you're getting on that price point for that home.
Yeah, I agree. And it's funny that rolls right into a question we got in the comments from Troy Roberts. Thanks for joining, Troy. And we appreciate the questions. Feel free to ask away if you're in the comments live. If we miss you live, I'll try to get in there and answer them, post-production when it's just sitting on YouTube. Troy's asking about, or kind of stating, I need to talk to my lenders to see what rates I'm looking at. Some advice for everybody, including Troy. Keep in mind that rates change daily. And so you can look at a snapshot in time and you can look at mortgage rates, but that is for December 9th at the time you're looking at it. Lenders sometimes reprice during the day. And so do it as a buyer to get a kind of a good idea. And I even mentioned in my comment back, Troy, that, it wouldn't hurt to get a rate stack from a lender to say, if I spent a point, I could buy this thing down to 6.375. If I just took the par rate based on my credit score, my down payment, my specific scenario, they're telling me 6.75 is what I would get with no cost on my end. Don't spend every waking hour of your life worrying about this and studying this thing, because 1, it's going to change every single day. And 2, with real estate, and I've worked with thousands of investors, like the rate you get is not the determining factor on, accumulating net worth over decades, right? A 6.6 versus a 6.7 is not going to change your life. Taking action, acquiring real estate, and letting time do its thing in terms of appreciation and whatnot is way more important. And I've just seen too many people, Nash, that like they'll spend a year and a half studying mortgage interest rates. That's not going to do you any good. That doesn't create any net worth for your family and your generational wealth. So look at it so you have an idea. As I'm shopping, I should use between 6.3 and 6.75 for this time being, whether it's investment property or primary, but don't obsess over it, I think is my warning.
Yeah, I would take a slightly different approach, but with the same bottom line, is that mortgage rates are a solution for a specific individual. When you're working with a professional, like a professional mortgage broker, which Matt and I both are, you're going to get someone shopping multiple lenders for different solutions, but every buyer needs a different solution. So I would always caution real estate agents, especially if you're trying to drive some, activity, letting people know that mortgage rates are down on a 1-month low. Like, that's great. Absolutely. Drive some activity. Hey, did you know that FHA and VA rates are back in the low 6s? Cool. Drive activity with that. But understand that one client, their solution that makes sense may be a 6.99%, and another client, they may be a 6.375, and someone else may be a 5.99. Is what makes the most sense for them. Be very careful about playing that game of, well, I've got a buyer and, my professional mortgage broker told them they need to take a 7.1. Ask why. Have those conversations. Hey, can you explain to me why you're recommending this? Why does this make sense for this particular client? And they should have a good answer for that. If you've got a mortgage broker or a banker or a lender or someone who works at XYZ mortgage company that's just saying, hey, my rates are at 6.5%, come get one here. Like, that's not mortgage lending. That's Burger King have it your way mortgage. And consumers and real estate agents are not savvy enough to know, does this interest rate make the most sense? There's always a cost benefit analysis that needs to be performed. And if you're going to spend the money to buy that interest rate, you're not going to recoup the differences in that for the next 3.5 to 4.5 years. that may not make the most sense for that client. It may not address their goals in the way that is going to be a smart move going forward, especially in a market where every forecast has got lower interest rates over the next 2 to 3 years. So keep that in mind. Make sure you're talking to a professional. Feel free to reach out to us, directly, even if we're not licensed in your states. We're more than happy to answer questions and give you an idea based on your audience, what you're trying to convey, what makes sense to share, and how can we drive the right kind of buyers who can take advantage of this right market and get those right people building their net worth, like Matt said.
Love it, man. I love it. Any last things we should discuss? I know Flow Ride. Maybe we'll answer this one as well.
Let's hit that question. I like it.
Is Credit Karma good for monitoring credit? Is there a FICO score from a specific credit bureau that's looked at most?
I always answer that question and say Credit Karma is as good for monitoring your credit as Zillow is for the value of your home, which is kind of a joke. But aside from the joke, let's get into how you can actually use these tools effectively. And to do that, we need to understand what Credit Karma is. Credit Karma is an advertising platform. They're there to sell you credit, to pimp your credit cards and get you some cool stuff. So they are spending the least amount of money possible to get you a credit report. That means it's going to be a 2-year history. It's going to be very limited on the data. And your scores, especially if they're lower, they're going to be anywhere from 40 to 60 points too high on Credit Karma versus a full FICO 8, Fair Isaac 2.1, FICO 5 analysis. Like, you're not going to get the same. You're going to get a bank card score as opposed to the scores that we use for mortgages. And honestly, there are too many algorithms. I wouldn't spend a lot of time learning all those different things because it's just, frankly, it's not necessary. Credit Karma is great for tracking month-over-month movement. Did your score go up 40 points? Are you focusing on the right things? Have you been paying down your debts and avoiding any new late pays? You'll see improvement there. But know that it's probably not going to equal the same score that you're going to get when Matt or I pull it. That's fine. It's great for tracking those month-over-month improvements and having something to get excited about. But that's how I would advise using a tool like that. It's free, and it's free for a reason.
Yeah, for sure. And, consumers all the time, since I've, been in lending for a decade and pulled who knows how many credit reports. I could probably buy a house with the amount of credit report fees I've paid in 10 years.
Dude, I can get a house out in your area with the ones I've pulled.
People are like, oh my gosh, I saw 785 on this algorithm. Why is my credit score 727 when you pull it as a mortgage lender? Like, retail credit pull at Best Buy is different than the credit pull that the car dealership pulls. That's different than the credit pull that the mortgage lender pulls. So know that. Don't be surprised. And then, just as an FYI for people wondering, as a mortgage lender, we pull Experian, Equifax, and TransUnion. All 3 scores. We take the middle of those 3 to determine, what type of pricing you're going to get on your specific loan. But it's a mortgage-specific credit pull. So it's not going to be the same as Credit Karma. It's not going to be the same as, the one that your Capital One card shows you, or, you just went and applied for a car loan last month and it was 785. Doesn't mean it's going to be 785 for us. So keep that in mind.
But if it is 785, it's probably going to be pretty good with us. It's the mid 600 stuff where it's like, hey, I've got a 620. And like, yeah, I got you at a 560. It's the old, it's the dirty, it's the collections, charge-offs. It's that stuff that doesn't usually show up. Looks like we have one more good question.
Before I want you to answer this one. This one's a hot topic. A-Rod, real estate investing, wants to know, box A is where all the lender fees are. Are these all negotiable?
At all negotiable. Negotiable? No. Movable? Yes. So here's how I'd answer that question. Box A is going to be your processing fees, your underwriting fees, your lender fees, broker fee, discount points, things like that. And most of the time, the majority of those fees right now are set up with points. The way that these rate stacks work, investors want their money now. They want to get that. So it's going to be, you're looking at an interest rate stack. It's like, oh, I can get a 7.25 and pay nothing, or I can get a 6.6 for less than a point. You just do quick math between those, and you're almost always going to buy down, especially just for affordability. They're going to try to get their money up front. So can you then negotiate what it costs to get that interest rate? No. Your mortgage broker, your mortgage lender, they're not sitting there looking at a rate stack like, well, I bet I can charge this guy $5,000 for this deal. We'll see what happens. Oh, I'll only pay $4,000. Okay, well, let me get you in at $4,000. Like, that's illegal. Can't do that. I can tell you 14, 15 years ago, we used to do stuff that's a little similar to that, where you kind of figure out where does this make sense and you be paid off of the profitability on the loan. Yeah, there's a good reason that that doesn't exist anymore. That's a lot of bad stuff. So now, like, rates and points, they are what they are. But what you can do is having that conversation with your professional mortgage broker. It's what makes the most sense for me and why. Hey, I want to get my box A cost down. I need to get my cash to close down. So now we're solving for a different X. Like, that's where that conversation needs to go. If we need to get that down, cool. Well, let's look at this interest rate versus this one, or this investor versus this one. Maybe this product instead of this DSCR. There's a lot of flexibility in box A. Now, I will say, you call a couple lenders and it's like, hey, random online lender has, $1,800 of processing, admin fees, and like underwriting fees. Could you tell them, hey, I'll go with you if you waive your $400 admin fee? Probably. When I was in the world of retail with a bunch of junk fees in my box A, now, I didn't have a bunch of them, but, I saw them a lot and I still see them now. Some of those could be negotiable. You could say, hey, I'm willing to do this if you get rid of X. And next thing you know, man, you may get a waiver there. But that's another good reason to work with a professional mortgage broker is we're not paid on your box A. We're not paid on collecting a whole bunch of junk fees. We don't have all this overhead that we have to roll in there where we could, make a business decision on whether or not to charge our, processing fee on something. Now, our processing fee goes to pay the processor. So, to answer that question, yes and no. If there's a whole bunch of junk fees in there, you're probably working with someone more expensive anyway. And so you're negotiating something that shouldn't be negotiable, but because they've just worked in those extra costs in there, yeah, you may feel like you get a win, but if you talk with an expert mortgage broker, you're not going to have anything that's negotiable. It's going to be a matter of what's the best fit for me and how do I, work this out into a solution that makes the most sense going forward.
Yep. Well said, brother. All right, I got to jump. It was a pleasure talking to you as always.
Yeah,
Some good CPI data this week, and we'll do this again next week.
Yeah, let's come back to good stuff, man. I enjoy it.
All right, thanks, buddy.
All right, take care.